Hi, everyone. I think we're live. Okay. This is Nasha Nova. Thank you so much for joining us today. I'm in the research team at the Global Impact Investing Network, and I'm joined here by my colleague Rachel Bass, also on the GIIN's research team. We're very excited to share with you some key findings and learnings from our recently published Understanding Impact Performance study that focuses on the impact performance of nearly 800 annualized investments in the financial inclusion sector. But even more importantly, we'll talk about why this work is so important and why it's particularly and why it particularly matters now. Before I begin, let me step back for a minute and tell you a little bit about the GIIN for those on the audience who might not know us. We are the global champion of impact investing with a broad network of over 30,000 individuals across 6 continents and a formal network membership of 350 leading impact investors across 50 countries. And we believe that as the impact investing industry grows and scales, it's more important now than ever to measure and report on impact performance. And of course, that will be our focus for today's session. For today's agenda, let me move on. Okay. We have about 15 minutes to walk through some study motivations and background, share, of course, the results and key learnings from our report, share some fun analytics that we've been working on, and then, of course, wrap up with the next steps and leave 10 minutes at the end for any questions and discussion. And by the end of the session, we hope that you can see the fruition of your work in the data, and we hope that you will be involved with us as we continue on this journey. And without further ado, let's dive into some background. So at the GIIN, we strive to create a world where social and environmental factors are the norm in routinely being integrated into all investment decisions. And to that end, our organization operates on a strategy with 3 key pillars. Of course, mobilize more capital for impact investing around the world, safeguard the integrity of impact investing, and fuel the global impact investing movement to change minds about the role of capital in society. And of course, measuring and reporting impact performance connects to all 3 focal areas, and GIIN research, where we sit, also fits well across all 3 here. But our focus today, as mentioned, is on impact performance. And with that, before I reveal to you the results, I also want you to keep in mind any data that surprises you, and of course, examples from your own work that align to these findings, or examples that don't. And of course, how do you envision using this data in your work? And how do you think results like this and analytics like this can be relevant to what you do every day? And I think with that, I will also start by sharing a little bit. Sorry, I'm still kind of adjusting to this technical platform. Okay, so before I, of course, reveal to you some results and key learnings, I want to provide a little bit on some of our approach to the study. We only collected data for investments that were made directly into companies rather than investments made through funds or other intermediaries. This is primarily to avoid double counting, both within our data set and the results. And of course, all investments were made into the financial inclusion sector. That is, investments made to enable the provision of credit, savings, insurance, or payment services with the intent to create measurable impact. We also asked that respondents to the study only submit annualized impact performance data, that is, performance within a 12-month period, so as to enable comparability between different investments. And when developing the questionnaire and determining the scope of the study, we leveraged standardized and evidence-backed impact metrics in IRIS+, the generally accepted system for measuring and managing impact, as well as a number of resources specific to the financial inclusion sector, such as Series SPI4, SPTF dimensions, and metrics by MIX and the Microinsurance Network. We also aligned the questionnaire and ultimately the report to the 5 dimensions of the Impact Management Project and the UN SDGs. And part of why we focus so much on this alignment is to cut down on the noise and ensure harmonization between industry to enable the deepest possible insights into impact. I also see some of the participants and advisors in the room today. So, and of course, including e-MFP themselves. So, would love to take just another chance to thank you for your contributions because this analytics and this report would not be possible without your input and your guidance. That said, we're officially ready to look at some results. Oops. Okay. So the financial inclusion sector is associated with a long track record of impact investments and was also the second fastest growing sector in the industry over the last 4 years. Yet, nearly 2 billion adults around the world lack access to basic financial services. So we're still pretty far from providing responsible and affordable financial services to all adults in the world. But this is where impact investing can and is playing a role. For this study, we collected annualized impact performance data from 46 impact investors that have collectively made 491 unique investments in the financial inclusion sector. Some investments provided data for multiple years, resulting in nearly 800 observations. So a little bit into who the investors were. They were mostly for-profit asset managers, medium-sized organizations, investing primarily into MFIs and fintech companies. Investors were also headquartered mostly in developed markets and used the SDGs and IRIS Plus to measure impact for the most part. Moving on to a snapshot of investment characteristics. So a huge chunk have been made either through private debt or private equity, and nearly half of all investees in this sample are small microfinance institutions. Over 90% of investments in this sample were made into emerging markets, primarily South Asia, Sub-Saharan Africa, and Latin America. And respondents also reported realized returns and financial performance relative to expectations, and the majority met their financial targets. And we have more data on how annualized returns varied between investments and asset classes in the report. So I would encourage you to take a look at that. And here is a quick breakdown of the types of financial products that investees in this sample provide. A little skewed towards credit, but these are other products and services are often bundled with credit. And this, as you know, is becoming increasingly common in the sector as questions around long-term impact outcomes and improved resilience become more prevalent. That said, we believe that the purpose of impact investments is to create sustainable impact, not just on outputs like the number of loans provided, but also longer-term outcomes. So we worked to deepen the analytic methodology of this kind of research and move our focus towards outcomes assessment. We think this approach is meaningful for two main reasons. First, it allows us to move beyond outputs and speak to those deeper impact that could result from impact investments, because the truth is, most investors aren't conducting rigorous randomized control trials or evaluations due to a range of constraints, naturally. But we hope that this approach can at least provide us with an indication of which impact outcomes are likely to be achieved. Second, data on outcomes is something that a lot of investors are curious about and want to track, primarily because they want to measure progress towards their own impact objectives, or they want to invest into the most impactful segments of the market. And of course, this could also potentially help them communicate their impact externally. So this can really create strategic business value for both investors and investees, be it for marketing or for product development. So this approach pulls together a variety of those output metrics, like individuals served or loans provided, that investors are collecting, and builds an impact pathway, as you see here. Notably, we focus mostly on shorter term outcomes, as highlighted, but we don't necessarily have the data or the tools to map to longer term outcomes, which might be better suited for evaluations or randomized control trials. All that said, we present to you the 4 impact pathways in the financial inclusion study. So given the metrics we had in hand and the IRIS Plus evidence base, we identified 4 key areas of longer term impact in the financial inclusion sector. First, decrease reliance on solely informal networks. through providing first-time access to finance in populations that previously only had access to informal alternatives like friends, families, or community groups, or even predatory informal alternatives like loan sharks, or no access at all. And we compared the number of individuals provided that first-time access to formal financial services to the total population of unbanked adults in the countries of investment. Next, we look at increased spending on basic services such as education and healthcare. Here, we dig deeper into the types of loans being provided, like education financing or home improvement financing, and consider loan quality indicators to assess that these are responsibly provided loans, and compare the number of individuals provided those loans to the population of individuals excluded from formal credit in the countries of investment. Third, we look at accelerated business expansion. So this pathway, again, also focuses on loans, but this time only on business financing and working capital loans provided to MSMEs, which vary from loans to individuals naturally in terms of loan size, interest rate, client protection policies even. So this is then weighted two ways. First, relative to the total number of credit-constrained MSMEs in the country of investment, and second, to those countries' estimated MSME financing gap. And last, we wrap it all up with improved financial resilience, where we dive deeper into bundled products like savings and insurance provided along credit, geared towards improving clients' ability to manage financial shocks over the longer term. And we also focus only on active clients for this pathway, to drive home the point that simply having a bank account with a financial services provider may not strengthen long-term resilience, but actively using that account is what can contribute to improved financial health, especially during times of shock. So that was a lot of information. Thank you for bearing with me. I'll just end by saying, I realize we're short on time, so I won't present the exact numbers to you today, but the full report also includes additional quantitative analysis and how that varies across segments, and a spotlight box for each of these pathways to highlight real-life examples of how investors and FSPs are working together towards each of these outcomes. To summarize, as you can see through these pathways, a number of themes apply across the sector. Of course, they are reflecting progress towards 4 key outcomes, but these are not the only outcomes. There's a lot of other activity that is happening in the industry as well. Investments reflect a commitment to enable moving beyond access and towards usage. 82% of the nearly 800 investments in this sample track the number of active clients, and almost half of investees provide multiple products. And nearly universally, investees have client protection policies, conduct repayment capacity analysis, and align to industry standards and certifications. And last but not least, opportunities for deeper impact and further impact investment remain, particularly in reaching underserved populations and through gender lens investing. Just under 40% of investments in this sample target women, and nearly 50% seek to increase gender equality through financial inclusion. And of course, these represent just a starting point for our understanding of impact in this space, and it's a growing data set. So we're hoping to continue growing it and deepen these insights. And before we move on to our analytics demo, I just wanted to pause here and see if you had any initial thoughts, questions, reactions. And of course, we also have some time in the end to take those as well.
And we really would love to hear from you. So please do feel free to drop any reflections into the comments, and hope to hear how this may resonate with your work.
We hope these provide a starting point for your thinking, but also okay if you want to save those for the end, in which case I'll just pass it over to Rachel to walk us through an analytics demo.
Great, thanks, Nashin. So as Nashin mentioned, there's a tremendous wealth of data in the report. And unfortunately, we can't unpack it all here, but the report is a public good, so it's available on the GIIN's website, thegiin.org. So definitely encourage you to take a look at that. I also wanted to share another analytic resource that we've built to complement the narrative and to provide a little bit more flexibility in how you can interact with and consume some of the really rich data that we have available. So one thing that we've built is a series of interactive dashboards that are also publicly available on the page for the report. And what these do is they provide an overview of the sample, a little bit more information around the 4 pathways that Nova has described, as well as the opportunity to customize the way that you view the data. There's a ton of information in each of these, so I'll just quickly kind of break it down so you can see how we're presenting it. First is we'll show an outcome. And in this case, it's the clients that are provided first-time access to formal financial services. So this aligns well with the pathway that Nashin described around decreased reliance on solely informal financial services. And what's shown here is each bubble representing one annualized impact investment. So the number of clients that have gained first-time access in a 1-year period per investment. At the bottom, you'll see some summary statistics of the average numbers shown. And this is meant to provide a view of the typical performance. But as you can also see, we're showing the distribution of results. And you can see there's a fair bit of variance, which is quite interesting. We then produced the same view of the following 3 pathways that are represented in the report. And one thing I'll note is that with each of these, we're considering a number of different factors. So those indicators that reflect quantity, the number of clients, the number of loans, as well as indicators that reflect the quality of the services being provided, whether these are being actively used, whether they include some measures of client repayment capacity analysis and other ways to gauge the appropriateness of the different products for their users. So all of this is really important in making sure that we capture the full picture. Additionally, it's really important to provide some context behind these. And so we've included a little bit of information around the stakeholders that are being reached, the nature of the different clients that have been served, as well as the types of products and services that are reflected in the sample here. And then lastly, we want this to be useful for you. And part of that is making sure that you can look at your specific peer group. And so we've built in a series of filters that allow you to dig into the segments that may be the most relevant for comparison. Together, what this information is meant to provide is a sense of the typical impact performance in a 1-year period, the range of impact results, and also how it may vary among these different market segments, financial returns, stage of business, the type of investee, how it may vary over time. You'll see the bar at the top that looks at the number of years that have passed since the investment was made, all of which can help shape investors' choices around how to structure an investment, as well as investee choices, the choices of the financial service providers around the nature of their profit offerings, their product offerings, as well as the way you may interact with and engage with clients. And then lastly, we see this being really relevant for thinking through impact accrual over time, to set targets, to shape exits from an investment, and a range of other key choices. One thing I just want to show as well is that this is dynamic. And so, Nashin, if we can switch to the other screen, we'll just show you how these figures can update so that you can look at those peer segments as are appropriate for you. So for example, if we look at the target financial returns, it may be useful to consider just the market rate sample. And so when you filter down, you'll isolate that subset of the data to see how that particular peer segment performs. So quite interesting to dig into. We won't show you all of the filters right now, but again, they're available on our website, so definitely encourage you to check that out. And again, please feel free to send us comments in the chat box, as well as follow-up reflections after this session, because we really do want to hear from you. With that notion, perhaps we can turn over to next steps and make sure folks have a way to contact us.
Yes. Okay, let me just switch my share. Perfect. And go back to PowerPoint. Oops.
One,
see my screen?
No.
Oh no. Sorry, my computer is acting a little slowly.
One thing I'll note in the meantime is that this is very much a work in progress. We're super excited about the leap forward that this represents, but also recognize that there's a long way to go. And so the GIIN is very committed to continuing to unpack the data, to expand the data set, and to refine these interactive tools and resources so they can be useful for investors and useful for companies that are trying to attract impact investment capital. With that, what I'll do is just quickly pull up Notion. I'll see if I can share from my screen.
Thank you.
And just leave you all with a set of kind of next steps for us. Great. So as you can see, we have quite a lot still coming up the pipe. The first thing that is noted here is that we have additionally released the methodology for comparing and standardizing impact performance information, again, available through the GIIN's website. And this methodology is released in draft form because we're eager for your insights and reflections on its contents and its utility and its relevance. So that's open to public comment through the end of January, and we welcome any reflections there. We're additionally expanding the resources on impact performance. And so in IRIS Plus, the generally accepted system for measuring impact, we'll be launching new core metric sets on quality jobs and climate change mitigation, two areas that of course have a really important overlap with the financial inclusion space, and then conducting impact performance analysis there as well. We'll additionally be conducting ongoing data collection so that we can strengthen and refine the data assets presented today and continue to generate more and increasingly nuanced insights. And lastly, as we encourage you to get in touch with us, we're always happy to hear how this work may resonate and if there's additional information that would be particularly useful and helpful. So feel free to reach out to us directly. And we've also included the research page so you can find where these resources are. With that, I think I'm seeing a couple of comments coming in. And so Notion, perhaps we can take a couple of questions. And if there are any more, by all means, please send them into the comment function and we'll be happy to discuss in our remaining few minutes. This first question I'll read, Notion, for you is that regarding credit, we understand that investment goes into loan capital, but what's meant with an investment into savings accounts? Can you share a little bit more behind that?
Yeah, great question. So I think, so firstly, the majority of investments in this sample were made into credit providers, but a big trend that we've seen is that the majority of investments provided more than one product. So savings accounts often came bundled with credit accounts, and I think that also speaks to the fact that nearly 20% of the sample were investments made into fintech companies, which are kind of democratizing that access and making it from specific products to like a unified platform that also enables the provision of savings alongside credit. Why I particularly like your question is it also surfaces the fact that not a single investment in our sample of nearly 800 investments provided solely savings. It was always bundled either with insurance products or with credit products. So I hope that answers your question.
Great. Nashin, one other question for you is if you could speak to the role of financial inclusion in the broader impact investing space and any trends that you may have observed there.
Definitely. So one thing that I started off with is that financial inclusion was the second fastest growing sector in the industry in the last 4 years, which is, I think it grew at like upwards of 35% per annum, and I think that speaks to just the potential for investment in this sector, particularly as gender lens investing also scales and grows. We also see a wide range of organizations in this sample. Candidly, it is mostly for-profit asset managers, but for basing a little bit on our annual survey data, financial services investors with at least some of their impact investing assets in that sector ranged from DFIs, that is development finance institutions, to family offices, to foundations. And we see that diversity in this study as well. So it's a very rapidly growing sector, even when it comes to diversity in org type, in geography, in asset class. I think primarily, like most of the industry, it's been focused on private debt and private equity, which we also see reflected in this study. But in the annual survey, there was a decent amount of impact investing activity in financial inclusion in public markets as well. So rapidly growing and pretty diverse.
Great. And one more question for you, Nashin, and then I think we'll be wrapping up. So if you can just take a minute to share any reflections on why there's relatively little venture capital in financial inclusion.
That is a good question. I'll start by referencing that in this study, nearly 50% of investments were made into either early stage companies or venture stage companies. So there is a lot of activity going into, relatively early stage financial services providers. In terms of broader segment, I might have to reference some of the annual survey data to see this, but my lean would be that there is plenty of activity that is happening in financial inclusion related to venture capital companies. But Rachel, I don't know if you have any observations that you'd like to share on this front.
Yeah, thanks, Nashin. I think that's right. It's really interesting to see the pretty strong showing of venture capital in the particular sample that we've explored today. And perhaps part of that is reflected in the evolution of the financial inclusion space. In some of the microfinance space where so much of your cash flows are contingent on offering loans, it makes sense for your source of capital to also be debt and to kind of match that. But what we're seeing now is an evolution towards some of the bundled products that Nashin has described and this broader set of product offerings, as well as to other modes of financial inclusion. So fintech specifically has seen a tremendous amount of growth and potential and is perhaps a bit better suited to certain types of VC investment. So definitely something to continue to unpack. But with that, I'm mindful of time, and I just want to leave you all with first, my gratitude for taking this half hour with us, and hopefully for digging into the report afterwards, but also just a note of hope. We have had quite a year, and I think that's evidenced in part by the fact that we're joining you today virtually. Nashin and I are two very different locations, and I'm sure so many of you on the lines are spread around the world as well. And part of what this has done is really put an emphasis on the critical role of financial inclusion in building strong foundations for resilience to shocks like the COVID crisis, as well as so many others. And we see that resonant in this study as well, that financial inclusion plays such a pivotal role. And this is why we're really excited to continue to grow the data set and the body of literature on this space. and really excited to join forces with you and to celebrate your work and continue to see it expand and evolve in the years to come as we drive towards that greater resilience. So just thank you. I hope that you'll get in touch and really appreciate you taking the time with us today.
Thank you so much, everyone. I sent some links to our full report as well as the dashboards in the chat. So looking forward to hearing your thoughts and feedback. Feel free to email us with those as well.